What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at a couple of things, including the fact that insiders are selling their stocks right now at a pace that they haven't been selling their stocks in a long time. If you look back at history, we can see a pretty tight correlation between when insiders start to dump a lot of their shares and the top of market cycles, or at least the top of temporary bull markets. And so what we're going to look at today is, number one, are insiders selling right now, and to what extent compared to history? And number two is that indicative that a market crash, or at least a short-term, bear market short-term correction or little crash is right around the corner? What other forces are at play here? Because that's not the only thing happening right now. Ready? Let's dive in. All right, guys, so insider buying and selling historically has a pretty tight correlation between, bottoms and tops of markets. And so we can look at some charts here and see that at all the times where insider selling peaked, that was usually a time when you had at least a short-term sell-off in the stock market, somewhat near then, following that period of time. And when markets are near bottoms, you have a big amount of insider buying. And that makes sense, right? No, so I'm not talking about illegal insider trading here. I'm just talking about the big boys with the money and are closest to the companies. They can see, hey, maybe the economy is taking a hit, but we feel really strongly about our future prospects for our company. And so, like in March and April, insiders were buying a ton of stock then. And so, clearly that turned out to be a bottom in the market. And so right now we're getting to a time when insiders are really starting to sell a lot of shares. So where can you see this information if you want to go, look at and monitor insiders buying and selling? Well, this is all public information, because for an insider, a legal insider to be able to buy or sell significant amounts of their stock, it has to be reported. And so you can go to the SEC forms. The Form 4s are the ones that show insiders buying and selling. And there are some websites that put this information together as well, like Open Insider, Tip Ranks, Insider Tracking, and I'm sure there are plenty of others. So we know that insiders are selling stocks right now at a much larger proportion than they have in the recent past. So if that's the case, why is the stock market continuing to go up? I mean, I know today we had, kind of a bloodbath in the markets. Pretty much every single major stock was down, unless Wall Street had a major short position on the stock, in which case those were the stocks that were kind of exploding today. And the other thing that went up today was volatility. But other than that, it was pretty much big red across the board. So who's doing the buying then? Retail. We've seen a big explosion in retail trading specifically over the last year, as people have had more time on their hands to learn about trading, to download apps, to watch stocks. People are working from home a lot more. They have more freedom to be able to watch, multiple things throughout their day, do a little bit of trading and investing in research while they're doing their job without somebody looking over their shoulder. And also we've got a lot of people that were, just putting their stimulus checks and their unemployment insurance checks into trading. We know that the number of retail investors has just exploded recently, and the amount of money that's going into trading and investing in stocks is more and more represented by the small investor versus the insider. Now, this is another bad sign, right? Because if all of the smart money is getting out and all the dumb money is getting in, and when I say smart and dumb, it's usually just related to size, right? When the big money is getting out and the small money is getting in, that again is another indicator that the market is at a top. The majority of the bull market is going to be ridden up by the smart investors, the long-term investors, and the big money. And as they start to get out, they're selling to the crowd that's getting in for the first time at the top. But that's not the end of the story, because this isn't the end of the bull run usually. Usually what happens then is you enter into a euphoric stage where you see euphoria and FOMO all across the board, and you enter into just a giant, blow-off top. And those blow-off tops where you see the massive, insane gains across the board, those are not being participated in by the big money, by the smart money, because to be honest, they know it's unsustainable. So the things that we're seeing happen right now with GameStop, with AMC, with Tesla over the last couple of months, it's likely that those type of gains and just unbelievable mind-blowing returns over the course of just a few days, few weeks, few months start to repeat and replicate themselves across many stocks over entire indices. Now, that's not the end of the story either, because just because you have a massive surge of retail investors and small money coming in to buy the blow-off top and push, stocks up to astronomical levels as the smart money gets out and sells to everybody who's getting in, that's not the end of the story. The other thing happening right now is buybacks are coming back, and buybacks are coming back big. Bank of America's Jill Hall wrote that buybacks of Bank of America's corporate clients over the last 3 weeks have picked up to their highest levels since March. Now, a little bit of a longer term perspective, when you look at the last couple of years, it's nowhere near that yet, but it's starting to pick back up again. And so this is a key thing to pay attention to and to watch. Corporations are starting to really significantly increase their stock buybacks, and some of what they're doing with that is using that as compensation. Well, these executives and officers, when they're getting their stock as compensation, they're going to be selling it. So that's contributing to the selling, especially because the prices of their stocks are going up due to the share buybacks partially. So you might be wondering, why does a company buying its shares back push its price up? Well, there are a number of reasons. Number one, the most basic answer is going to be just supply and demand, right? When you've got a lot of money buying shares of a company, that's going to be buying pressure. It's going to soak up everybody who wants to sell those shares, and it's going to push the price up if there's enough buying. So just buying pressure in general, even though it's of their own company, that itself will push the price of the stock up. Now, number two, it actually increases the fundamentals of the company. It makes them better, because if a company earns, let's say, 50 cents per share, but then the company goes out and they buy, let's say they buy half their stock, half their shares that are outstanding. Now there's half the number of shares available for people to buy. And let's say nothing changed with the amount of money, the amount of earnings, the profit that company makes, their business stayed the same. Well, now their earnings per share doubled, because there's half the amount of shares, their revenue, their profits, their earnings stayed the same. That means their earnings per share, there's half the shares, so the earnings per share doubled. And so by buying back shares, a company can directly impact its fundamentals. And if a company's fundamentals are improving and getting better, their earnings per share is going up, their debt to equity is improving because they're using the debt to purchase shares, which is driving the price up, so their debt to equity improves. It's really an easy way for a company to deploy capital and get results that make its shareholders happy, that encourage the shareholders to buy more, which then again drives up the price even higher. And usually it has a far more powerful impact for the actual cost of delivery compared to doing something that will improve the actual operations of the business, like, I don't know, building a new factory or investing in another country or hiring more workers or growing one of your divisions, something like that. So you might be thinking, well, is this actually sustainable? How long can this go on? Well, it depends large in part on interest rates, because a lot of these buybacks are funded by debt. And as interest rates stay low and move lower, it stays easy and gets easier for companies to continue to use more and more debt to purchase more and more of their shares. So is this stock market crash right around the corner? It possibly could be, especially given today's price action. I would expect that this is a temporary pullback, but it could very well be that we're very near to a sizable market crash. Is it possible that we see a euphoric wave, a FOMO rally across the entire stock market? Absolutely, especially given what's happening with monetary and fiscal policy. If we see a continued collapse of the dollar relative to goods and services and assets, we could absolutely just see this thing go up. But as this process continues to unfold, corporations use debt, they buy back their shares with it, they award officers and employees with stock as compensation, and then that stock is able to get sold, and it's not having an adverse effect on the actual share price of the company, because the company is using money to buy back those shares. Smart money's getting out and retail money is jumping in as we start on this last euphoric wave. That's absolutely a very big possibility of how this plays out over the next year or so. All funded by the continuing collapse of the dollar relative to goods and services and products and assets, and not relative to other currencies, because most other currencies are in the same boat. So how can you participate in this without getting burned? Well, one way is just heightened risk management, right? Because if you are going to be investing or trading during these turbulent times, you have to be extremely disciplined and have measures set up in place that are rules based, so that you don't get into a position where you're like, hey, I'm 10% down, but I think it'll come back, so I'm going to hold on. Now you're 15, 20, and now you're just saying, I'm going to hold on until it comes back. And you wind up getting into this downhill spiral of, hey, I'm just going to hold on until it comes back. And then as soon as it comes back, you're going to sell. And then overall, you continue to repeat this destructive pattern to your portfolio. And it ends up being that the only positions that you're ever holding are ones you're at a loss at. And anytime you have a gain, you sell way too early because you're so concerned or scared about it turning into a loss. So risk management is key. And one way to do that, not a recommendation, but one way to do that is to use options instead of using 100% of your portfolio and deploying that in a way where you have to have tight risk management on all your positions. You take 90% of your portfolio, put it off to the side in something safe, stable, doesn't move, and maybe take 5 or 10% of your portfolio and deploy that into leveraged derivatives like call and put options, and use those. And since each one of those is so leveraged, it's risk management built in, because you're not using the rest of your portfolio. You're using tiny amounts to make bets on moves. So that is one strategy. If you're interested in learning how to use options, I've got both a beginner's course about the foundations, the fundamentals of options, and an advanced course for people wanting to start to use the more advanced strategies. They're both linked in the description below. As always, I really appreciate you guys. Have a good day.